started. So, hello students, hope everyone is fine. So we have the Pearson Edexcel International GCSE 4AC1 paper, the Pearson Edexcel, and we are going to solve paper 2 of January 2023, one of the most recent papers, okay? Getting it? So let's start with the question number 1, okay? So question number 1 is based on different topics. We have manufacturing, we have partnership as well, we have some part of ratios as well, okay? Getting it clear? So let's write it down that, sir, this is basically what? January 2023, getting it clear? And paper 2 for the Edexcel accounting, okay? With me, getting it clear? Following, understood, no problem, right? No issues? Clear on that? Sure, no concerns? Got it? Okay, so what we can say basically the first question, we need to understand that this paper is for 1 hour 15 minutes. The paper is for 1 hour 15 minutes, and we had the paper marks, our total marks for the paper is 50. So paper will have 50 marks and 1 hour 15 minutes is the paper. Okay, so we have state indicating with a tick. So we have to state indicating with a tick where each item will be shown in the financial statements of manufacturer. So we have to indicate by a tick where each item will be shown in the financial statements of a manufacturer. We have manufacturing accounts, income statement account. Okay, so manufacturing accounts are income statement, and whether it will be called a prime cost or factory overheads, okay, or whether it will be called an income and expenditure. Okay, understanding, getting it clear with me? Following? Any problem? Understood?
Yeah.
Getting it? So we need to understand whether it will be in prime cost, whether it will be the manufacturing cost, income or expenditure, where it will be coming in. Okay, so that's what we need to learn here. So let's get started. What we need to understand that when we talk about production things, okay, so when we are going to talk about production related, manufacturing related, factory related, it will always going to come in the manufacturing overheads. Okay, it will come in the manufacturing account. Okay, so what we can say that the wages, if the wages are for the production staff, definitely the wages for the production staff are going to become where the wages are basically for the production, that is the office where the labor is working in the factory manufacturing, so they will be called wages for the production staff will be called the prime cost. Okay, getting it clear? Because it's a direct cost. Okay, it's a direct labor cost. Okay, understanding that?
Yeah.
Wages, this the other name for this is direct wages or direct labor, because these are the workers directly linked with production. These are the labor who is working directly manufacturing the product and working on it. So we have wages for the production staff. Then the other one is wages for the office staff. Okay, so this is very good thing for conceptual purpose. We have to do wages for the office staff. Okay, so what will be the answer for wages of the office staff? Always remember, anything related to office will come in the income statement. Okay, so anything related to office will come in the income statement. So wages for the office staff will be an expenditure. So you're going to put the tick over here, sir, that wages for the office staff will be coming in the income statement expenditure. Got it? Clear on that?
Yeah.
Following? Clear on this?
Yes.
Sure about it? Okay. Wages for the factory supervisor. Wages for the factory supervisor will be the wages for the factory supervisor. Now we have to talk about that the wages for the factory supervisor will be the word itself says the factory related. So the worker that is supervising there, the supervisor, manager, they will be part of the manufacturing account. They will be considered under factory overheads. That is not directly related. So factory supervisor are not directly related to the production process, but they are basically they are doing the supervising job, and they are basically part of the overheads. Okay, so we have to classify wages of
Yeah.
factory supervisors as part of the factory overheads. Got it? Clear? Understood?
Okay.
Getting it? Okay.
Yeah.
Next, we have the carriage outwards. So where will carriage outward comes? Always remember that carriage inwards is basically part of the manufacturing account. Carriage inwards, if we have carriage inwards is basically the cost that is coming into for the production process, the cost that you have to bring the raw materials to your factory from the warehouse or from any other location. That is basically called carriage inwards. Like for example, there's a place X, you buy it from place X, the raw material, and you have to transport it to your factory, which is located here. So we need to understand that this will be called carriage inwards cost, which will be coming in the manufacturing. But carriage outwards is basically the cost that is being incurred for selling purposes coming in the lower half, that is the profit and loss account. We need to understand that when you have already manufactured the good, when you have already finished the product, you have to sell it to your outlets, right? You have to sell it to your shops and you have to send it to there. So let's say this is the factory and this was the raw materials warehouse place. The cost of bringing the raw materials warehouse to the factory is basically carriage inwards, getting it, and from the factory to the outlets, to your outlets, to your retail stores, okay, that cost is basically called carriage outwards. So that's therefore carriage outward is part of the expenditure, okay, getting it. Carriage outwards will be called the part of the carriage outwards will be called part of the income statement expenditure, okay, that's an income statement expenditure, okay, getting it clear?
Yeah.
Getting it clear, following, understood?
Yeah.
Carriage outwards, got it?
Yeah. If it's carriage inward, where would it come?
Then very good. Carriage inwards, think about it. You tell me where would carriage inwards come? As I said that carriage inwards should be coming in manufacturing accounts, okay? So carriage inwards should come in prime cost or factory overheads.
Prime cost.
Exactly. Carriage inwards will be counted as prime cost because it is the cost being incurred with the raw materials. If we are associating it with raw materials, it will be coming above, okay, in the prime cost section, okay? Getting it? Very good job,
Okay.
okay? Got it? Any questions up till now? Any questions in part A? Let me know. Understood this?
Yeah.
Then we have decrease in the provision for doubtful debts. So you need to understand that a provision for irrecoverable debts, the bad debts or the irrecoverable debts, we have a decrease in that, which will be called, sir, there's an income for us, okay? So this will be an income in the income statement. Irrecoverable debts are only linked with the income statement, okay? So irrecoverable debts will only be linked with the income statement, and therefore we are going to tell the examiner that decrease in provision for irrecoverable debts is an income for the person, and that is why we'll record in the income section, okay, got it clear?
Yeah.
What about royalties that are paid? Royalties is a very clear example, easy example. What about royalties that are paid? So it's very simple, sir. Royalties are basically direct
Cost.
expenses, okay? Yeah, these are basically royalties are basically direct expense. So anything direct material cost, direct labor cost, or direct expenses, they are all part of prime cost in the manufacturing account, okay? So this will be coming in the manufacturing account as well. That is royalties that are paid, okay? Understood? Got that clear? With this part A finishes and we have got, sir, all 6 marks. Okay, any doubts in that? Let me know, clear on that.
If it only says provision for irrecoverable debts, would that come in the income statement?
If your question is that, what about provision for irrecoverable debts, right? Only that set.
Yeah.
If it's written only provision for irrecoverable debts, we need to understand that it will be part of income statement, but then we cannot write whether it's an income or expenditure. Are you getting it? Provision, what I'm trying to explain here, that provision for irrecoverable debts is basically an item of income statement. Okay, I'll repeat. Provision for irrecoverable debt, students, is basically a part of income statement. So, but whenever, if there's an increase in provision for irrecoverable debt, it will be recorded as an expenditure. And if there is a vice versa, if there's a decrease in provision for irrecoverable debt, it will be recorded as income. Okay, understood? Getting it clear? Following?
Yeah.
And getting, got it? Sure, no problem.
Yeah.
There is that the next part is there is Bella and Chand. Okay, so there we have Bella and Chand, or Bella and Chand, B and C. So we have B and C, they are in partnership. So we have B and C, they are in partnership, sharing profit and losses equally. So they are sharing profit and loss equally. The next part we are doing now. Bella and Chand, they are sharing profits and losses equally in the partnership, and they provided the following information at 30th September 2022. So they have provided us the following information at 30th September 2022. Their information is given to us. What we need to do is basically we need to make the statement of financial position. At the end of there, we have to make the statement of financial position for them at 30th September 2022. Getting it clear for 12 marks, okay?
Okay.
Understanding? So let's try to
Yeah.
make it by putting some lines there, okay? So here we go. that this is the first line, second line, okay, and then we have, let's say, two lines are enough, two columns are enough. Let's start. So what do we have in the statement of financial position first? Always remember that we're going to do according to format as well here, and this is what we have. So we'll do according to format. So always remember, in the statement of financial position, the first thing we have, students, is basically the non-current asset. So this is basically a format as well, okay? Getting it
Okay.
clear? So here we go. So it will be starting off with non-current assets first. So it will be non-current assets. And what assets we have? The non-current assets, we have property, plant, and equipment. So we have, sir, property, plant, and equipment. Getting it clear with me, following? Understood?
Yeah.
Property, plant, and equipment. Okay. We have that as the asset. So it will be, understanding perspective will be simple here, that we need to understand that there is a cost section. So for the first part, we have a cost section as well. Okay. Let's make it a simple small one, cost section. Okay. Let's do it here. Okay. A little bit. Getting it, falling?
Yeah.
So you have to write down cost is here. Accumulated depreciation is there. And then you have the net book value as well. Okay. Understood. Got it. Clear on that? Any problem? Any
Yeah.
questions?
No.
Okay. So that is what we have here. Okay. So let's write it down. Let's take another line to do it. So property, plant, and equipment. So the cost is 65,000 and the provision for depreciation is 18,050. So you can say cost is 65,000 and 18,050 is the accumulated depreciation. 65,000 minus cost minus depreciation is the net book value that we need, students. So it will be 46,950 as the net book value. Got this?
Yeah.
65,000 minus 46,950 will be our net book value. So that is basically what we got from the first part, students. Okay. Understanding, getting it? These will be
Yeah.
finished off. Okay. So we got non-current assets. Then we will do current assets. Okay, students. So we'll do current assets now. Current assets for this partnership in balance sheet. That is statement of financial position. So we have to do current assets now. Getting it clear with me, falling? So how many current assets we have? The current assets are basically, we have inventory. The first thing that comes to mind should be the inventory. Okay.
Yeah.
So we'll write down that first step will be inventory. So inventory will be how much? Inventory is basically 38,800. Getting it?
38,000.
Just
Yeah.
remember that you should know the format and you will be able to do this. Understood? Getting it with falling? So inventory
Yeah.
is 38,800. Got that? After inventory, we will have a bank and we have petty cash book. We have trade receivables as well. Falling? Okay, so what we
Yeah.
need to understand that we have trade receivables and we have provision for irrecoverable debts as well. So follow very carefully how these things work. Basically, it will be so simple. So we need to understand that it will be trade receivables coming in here now, and you will have to show the adjustment for it. Okay, understanding? Trade receivables, you will have to show the working for it. Okay, clear on that? So it will be, sir, trade receivables were, because after inventory, the second item in current asset is basically trade receivables. So 27,600 minus 380. Okay, that's what you have to show. Okay, so we got 27,600 minus 380, and that is the answer we will get. Okay, so 27,600 minus 380, I am getting that as 27,220. Okay, understood? Getting it clear on that? Any
Yeah.
doubts, any problem? So we got
No.
inventory, trade receivables, then we can write down bank and petty cash. Okay, so bank balance is 4,775, sir. So we have bank balance.
So provision for irrevocable debts and will be both in the income statement and the SOFP.
Exactly. So we need to understand that in the income statement, we write only the increase or decrease of the irrecoverable debt provision. Okay. I'll repeat, in the income statement, we only write increase or decrease of the irrecoverable debt provision in the income statement. But in the statement of financial position, we write the closing balance, which is $380 here. Okay. Understanding? And definitely we'll be solving paper one question. And in paper one question, we have to make the irrecoverable debts accounts. So we'll be talking about in more detail in there. Okay. In there as well.
Okay.
Getting it?
Yeah.
Following? Understanding? Getting it clear?
Yeah. Yeah.
Okay. Got the point. Okay. So we got this provision for irrecoverable debts as 380. We have written down, we now have to bank and petty cash accounts column. Okay, so bank is basically 4,775 balance. Okay, and petty cash 4,775, and petty cash will be 125. Okay, so petty cash will be 125. Okay, understood? Getting it?
Yeah.
4,775, and we have petty cash as 125 balance. So these are all the assets, and we'll go according to the format of assets is equals to capital plus liabilities. Okay, so assets is equals to capital plus liabilities. So here we go. We can add the assets now, because basically this paper two focuses on the formats. Do you know the formats? Do you know the working? Do you know which thing will come in where? Okay, that is what paper two is all about, the formats and understanding of your theory and knowledge. Okay, paper one is more about
Yeah.
MCQs and those things. Okay, so that's why we need to focus here, that you must know how to write down, how to make the statement of financial position. Okay. So here we go. 70,920 is the answer for the current assets. And then we add this with the non-current assets. So we are going to get 117,870. Okay. Understood. Got it. So 1,17,870 dollars is the total assets. Okay. Understood. Getting it clear? Any
Yeah.
problem?
No.
So we got total assets as basically we are having said total assets as it will be 117,870 are the total assets. Okay. So we'll get
Yeah.
some marks for that as well. Then we start off with the capital, equity, and liabilities, right? So we'll write down that we have equity section and the liabilities section. Okay, getting it clear? Equity
Okay.
and liabilities, we are starting off, sir. So it will be, if we talk about equity and liabilities, so the first thing that will come to mind will be the capital, okay? So capital accounts we'll have to put first, okay? So the capital accounts of the partners, okay? So let's say capital accounts we have to put. So what will be the capital accounts? And we'll put the current accounts as well of the partners, okay? Understanding? Getting
Yeah.
it? Then what is their capital account balances and current account balances? And make sure just highlight all of those that we have already taken into account. We have taken this into account, the bank value as well. We have taken, sir, inventory into account as well. We have taken, sir, the property, plant, and equipment as well into account, right? With me following?
Yeah.
Understanding? We have taken petty cash as well. We have taken trade receivables as well. So these adjustments are already taken. So now only four things are left: capital account, current accounts, and the trade payables, other payables. Okay, understanding? So the best thing
Yeah.
will be that you write down in the horizontal form, that is Bella and Chand. Okay, so let's write it down here. We'll need the third column again now. Okay, so let's make the third column again. So try to make small columns so that every information can be adjusted here. Okay, understanding, getting it?
Okay. Yeah.
So here we go. We have Bella on the left hand side and Chand on the right hand side. Understood? Getting it?
Mm. Okay.
And we'll write down their capital account balances and the current capital. So capital account balances are for both of them 50,000, 50,000, sir. So here we go. It will be, sir, 50,000 for both of them, 50,000, 50,000, which will eventually make it 100,000. Okay, right? On the first most column. Okay. If we talk about the
Okay.
current account, we have both of the current account positive students. So we have 10,500 and 3,450 as well for Chand. Okay, so 3,450 as well for Chand. Okay, getting it clear?
Mm.
Understood? So it will be 10,500 plus 3,450. I got it as 13,950 as the answer. For the current account, I added both of them. So make sure if it is, these are all positive balances, credit nature balances. If anything was in the bracket, it would mean that it's a negative balance. We have subtracted it. Okay. If it was in the bracket, it means that you would have subtracted it. It's a negative thing. Okay. Understood? Got it? So you can add both
Subtracted
the
from the
capital and current.
capital account.
Can you repeat? Sorry.
Oh, if it's debit, then I would subtract current account and capital account.
No, let's say this was let me give an example. Let's say 3,450 was a negative balance, like in the bracket, okay? So you would have done current account 10,500 minus that, okay? Understanding 10,500 minus 3,450. We have done it like that, okay? Understood? Getting it?
Okay. Okay.
So that is what is the difference here, okay? Sure about it? No problem. Got it?
So if both of them are in bracket, I
Then
subtract from capital.
yeah, exactly. Then you have to negative negative becomes positive, okay, the mathematical way. Then you would have to add them, but show as a negative total amount. You will have to add them, still you have to add them and show as a negative amount, okay? Getting it?
Oh,
Any more questions, do let me know and ask, okay? Just make sure the important understanding is if the bracket is there, it means that the current account is negative. The partner have drawn more withdraw than putting in. So less earnings are there and you've done more expenses. So that is the important thing. And at the moment, we have both of them positive. So both of them are doing good. That's why we have added both their current accounts and both their capital accounts and added in total, we got 113,950, which will be called total equity as well. Okay, understood?
oh,
And then you just have to talk about the liabilities. Since we only have other payables and trade payables, which means these are only current liabilities. We don't have long-term liabilities, sir. So it will be, sir, current liabilities only. Getting it clear with me? And
yeah.
you can add them later on. So it will be, sir, current liabilities, which are basically the trade payables and the other payables. Okay, so we have trade payables and we have other payables as well. Okay, understanding, getting it clear, following.
Yeah.
So we have trade payables and other payables, that is basically 3,490 and 430. Okay, so it will be, sir, 3,490 and 430. We add all of them, so it will be 3,490 plus 430. That is basically 3,920. Okay, understood?
Okay.
Just add all of them and you will get total equities and liabilities. This will be equals to as well the same thing. Okay, getting that clear, following? No
Yeah.
problem. So it will be total equity and liability. When you add them, it will balance off and we will get all 12 marks. That was that the question. This is question part is basically for 12 mark students. So we will get all 12 marks here. That is
Oh,
113,950 plus 3,920. I'm getting 117,870, which is matching. So we have got the balancing done as well. Clear on that?
yeah.
Any doubts, any clarifications needed? Let me know. Must
No.
take a screenshot for this part. Okay. We have done any doubts, any confusions, any questions, do let me know, do ask. Okay.
Yeah. Sure.
So what we have to understand is basically we have talked about manufacturing perspective. We have talked about how do we make a statement of financial position. How do you make a statement of financial position for the partnership and some adjustments related to it as well. Okay.
If it says only irrevocable debts, would I still subtract it from trade receivables?
Yeah, yeah. Probably
Uh,
if it talks about irrecoverable debts as well. No, no. You're saying that if they say here only irrecoverable debts, right?
yeah. No provision.
Then you don't subtract. It's already subtracted, it means, okay? It's already
Okay.
subtracted. But if the irrecoverable debts are written in the adjustment, let's say in the later on part of adjustments, then you have to subtract. It's a very good question, okay? Getting it? So understand, because it's if it is already mentioned in the trial balance, very important question, okay? So what we need to understand, if the irrecoverable debts are mentioned in the trial balance, it means we have already subtracted it from the receivables. We have already subtracted it, removed them from the receivables. We don't have to do it again, okay? But if they are written in the adjustments, like the adjustments number 2, 3, 4, 5, 6, at the end of the year, then we have to do the adjustment. We have to subtract it from the trade receivables, okay? Getting it clear?
Yeah.
Sure about it? Understood? No problem, no issues, right? Got it?
Yeah.
Next thing we have to complete off question number one, that is of 25 marks, we have to write down the formula that will be used. Okay, so we have to state the formula for each ratio. Okay, so we have to state the formula for each ratio for 2 marks. And then for 5 marks, we have to evaluate the change in profitability from 2021 to 2022. Okay, so we have to evaluate the profitability. So the first ratio we need is, sir, profit for the year as the percentage of the revenue. Okay, so profit for the year as the percentage for the revenue. So it's very simple. You can just simply write it down, that profit for the year divided by the revenue. Okay, understood? Getting it? It's basically profit for the year divided by revenue into 100. Okay, so try to fit in the words in the box only. Profit for the year divided by revenue into 100. That is the formula for the profit for the year divided by revenue into 100. Understood? Got the formula for the ratios?
Yeah.
And then you
Yeah.
also have return on capital employed. So return on capital employed is basically profit before interest and tax divided by the capital employed. Okay. Return on capital employed will be the profit before interest and tax. Understood getting it? But for this case, I think we can keep it simple as well. Profit for the year divided by capital employed. Okay. In 200, you can write this as well, and you can write as well that is basically profit before interest and tax if you are looking from the perspective of the company. Okay, so profit before interest and tax, profit for the year divided by capital employed into 100. So that is the formula for return on capital employed. Okay, getting it?
Okay. Yeah.
Understood. Now we have to talk about evaluate the changes. Okay, so we have to evaluate the change in profitability from 2021 to 2022. Students, we have to evaluate the profitability. So we have been given the ratios and we'll try to work it out. Okay, so we need to understand and you need to give a conclusion for 1 mark, how the 5 marks are split. 4 marks, you can talk about what's happening, what's changing. But for 1 mark, you have to give a conclusion whether the performance is in good or improved. Okay, getting it clear with me following? So
Yeah.
what we can see from 2021, it was 15% to 2022, 18%. So the profit for the as a percentage of revenue grows, but return on capital employed from 7% to 5% have gone down. Okay, have gone down, right? Getting it?
Yeah.
So that is what you have to write here, that the profit for the year as the percentage, so the first one will be that, sir, the profit for the year, the profit for the year as percentage of revenue, has improved. Okay, has improved, so you'll get 1 mark for writing has improved from 15%, has improved from 15% to 18%, right? Getting it? So it has improved
Yeah.
by nearly 3% over the year, which indicates why it could have been done. How is it possible? How is it possible that your profit is coming more now as the percentage of revenue, which indicates lower expenses. Okay, the lower operating expenses, which
Oh,
indicates that the expenses were done less. Okay, getting it? Because
okay.
what it means that our profit increase. How can our profit increase? When we reduce the expenses. Okay, when we must have reduction, which indicates reduction in the expenses, or control, which indicates reduction or control in the operating expenses. Getting it clear with me? So this will give
Okay.
you 2 marks. Okay, once you have talked about why is it increasing, why it is improving, you have talked about that it is improving, sir, and why it is improving, that you have also given the idea. Okay, the profit for the year as the percentage of revenue has improved because of the reduction or control in the operating expenses. Got it? Clear?
Yeah.
Following? And the next one you can write the return on capital employed is what? The return on capital employed has worsened. Okay. The return on capital employed has worsened from 7%. What is the return on capital employed? How much the capital you invested, like your long-term liabilities and your equity, and how much the profit is generated against that. Okay. Understanding how much the profit is generated against the long-term equity and the liabilities that you have invested. Okay. The return on capital employed has worsened. Okay, has worsened, as we can see, from 7% to 5%. You can write down like this as well. Understanding?
Yeah.
7% to 5%, and you have to get the reason why. Because the return on capital employed from 7% to 5%, leading to inefficiency of resources being used. Okay, so leading to that the partnership is not using the resources properly, leading to inefficient use of the resources. Getting it clear? Inefficient
Okay.
use of the resources. There can be other reason as well. Maybe the capital employed, the profit is not, there is wastage, there is not productivity is gone down. Okay, so that is the thing. Okay, so now what do you think? What you can say is what happened, what overall profit is increased or decreased. So overall the profitability has worsened, or in conclusion, you can write down the word. Getting it? Overall the
Yeah.
profitability has worsened. Okay, that's your conclusion. Why? Because your capital employed is less, capital employed is not working properly because it was 7%, it has 5%, and there's only 3% increase. So overall, the profitability has worsened in general if we talk about, okay? Understood? Getting it clear?
Yeah.
Got it? Any problem? Let me know. Any question?
No.
Sure about it? With this, we
Yeah.
got our 25 marks complete, okay, for question number one. We have completed the whole question, students. That is question number one, the about the paper two, okay? Getting it clear with me, following? Understood?
Yeah.
Should we move forward to next question, right? Clear? So we
Sure.
can finish the paper as well, okay? So here we go. The next question talks about, it's basically about, basically about the incomplete records. You can say the first question was about manufacturing, and you can say partnership and the ratios, okay? So let me write it down that this question was about manufacturing, partnership and ratios all together. Getting it clear?
Yeah.
Question number one was about all about manufacturing, partnership, and ratios. Question number two is about incomplete records, income statement, and those things. Okay, getting it clear? So what we have, students, is the opening and the closing balances. There is Yamini. Yamini purchases and sell goods on a credit basis. So she does it on a credit basis, like which means she will have receivables and payables. Okay, getting it?
Mm.
So what we have is basically Yamini purchases and sells goods on a credit basis, which means she will have a lot of customers and lot of customers and lot of suppliers as well. It also means the same thing that she must have debtors and creditors because she is working on the credit basis and not the cash basis. Okay, understood? Getting it? She provided the following information for the year ended 30th September 2022. So she has provided us with all of this following information for the year ended 30th September 2022. Getting it clear with me?
Yeah.
Understood? So we have opening motor vehicles, inventory, other payables, other receivables, trade payables, trade receivables. We have bank summary. We'll go through in detail. So the first thing we have to calculate for 3 marks is calculate for the year ended 30th September 2022 the credit sales. Are you there with me? Getting it? So what we
Yeah.
need to understand, basically they are asking you, they are checking the concept of yours on the control accounts as well. Getting it, guys? Clear? Following?
Yeah.
Do you know about control accounts?
Yeah.
Okay, so we have to make control accounts here to get the credit sales and the credit purchases for 6 marks, 3 and 3 respectively. So here we go. How can you calculate the credit sales? Follow carefully, but just by doing this, that is making a T account. Okay, getting it clear? So you have to write down that we are making a sales ledger control account. Okay, with me following. Sales ledger control account is the total debtors, or you can say customers account on whom on or to whom Yamini has done the credit sales. Okay, to whom Yamini
Yeah.
has done credit sales. We'll write down all those. Okay, so here we go. Make sure, follow very carefully about the opening and the closing balances, sir. This is the opening balance, student, and that one is the closing balance. Okay, understanding? Got it? We need to understand here. This is opening balance and that is the closing balance. Understood? Got that? Clear? Very important to identify and judge. Okay, very important to identify and judge what is the opening and what is the closing balance. Okay, clear on that? Sure, understanding, no
Yeah.
problem. So here we go. Our opening balance is 21,400. That is will be balance brought down because it's a positive nature account. So balance brought down will be 21,400 and balance carried down will be the closing balance will be 32,500. That will be balance carried down. Understand? Getting it clear? Then you need to see how much the customers have paid you. So how much you have received from your customer students during the year. Bank summary is there. During the year you have received from your customers 167,650. Okay, during the year you have received from your customers 167,000 167,000. Getting it with me?
Yeah.
167,650 receives from customers. Okay, receives from the customers. Okay, that is the payments that they have made. So here we go there, that will be giving us our credit sales. On the debit side, that will be called the balancing figure as well. Okay, understood with me? Getting it? So just add them and subtract and get the final answer. You can do it here as well. 167,650 plus 32,500 minus 21,400, sir. So here we go, 167, 650 plus 32,500 minus 21,400. That is what we need. 178,750. Okay, so we got here 178,750. Understood? Got it? See if
Yeah.
you got understood, clear on that. Any problem? So this is going to be our answer, sir. 178,750. Okay, clear on that? Any problem? Any questions? Let me know. We have got the sir credit sales. Okay, sales ledger
So
control account. We
there's
have
no
got the credit
difference
sales.
between
Let me know.
sales
Can you repeat?
ledger. Okay, so there's no difference between sales ledger control account and trade receivables control account, right?
Yeah, that's the same thing. That's the same thing.
Okay.
Exactly same thing. Okay.
Yeah.
Next, we move on. We have to make sure the purchase ledger control account in the same way for the 3 marks. Okay, so here we go, sir. It will be purchase ledger control account. Okay, getting it clear? Will be
Yeah.
purchase ledger control account for the suppliers. Okay, we can say, or our trade payables or suppliers, we can say. So understand it's a liability. So balance brought down will start from here, sir. Balance brought down will be here, and balance carried down will be here the opposite way this time. Okay, understood? Because it's a
Yeah.
liability nature, so it will start from there. Trade receivables control account was a debit nature asset. That's why we said the balance brought down on the debit side. Okay.
Yeah.
What we need to understand, opening balance 15,500, sir. 15,500 opening balance. Closing balance is basically 12,750. Closing balance is 12,750 there. And next thing we have is basically how much payments are being made to Yamini. So how much payments are being made to Yamini from the suppliers? Sorry, how much payment is Yamini making to suppliers? My bad. How much payment Yamini is making to suppliers? That is trade payables of 92,750. The payments she is making, so it will be payments here this time. Payments to suppliers, that is 92,750. Okay, getting it?
Yeah.
92,750. And here we go, sir. We will get the balancing figure of credit purchases. We will got the balancing of credit purchases. That is basically coming here, credit purchases, the balancing figure, and you can work it out below as well by saying that it will be 92,750 plus 12,750 minus 15,500, and I will get the final answer. Okay, understood? Getting it clear?
Yeah.
So 92,750 plus 12,750 minus 15,500. I am getting credit purchase as $90,000, which must be correct, and it is correct. Okay, understood? Getting it clear? Now we are getting the values following. That's how we make purchase ledger control account and get the answers. Okay, clear on this?
Yeah.
The point to be noted is if it was return inwards or return outwards, you would have accommodated that as well. If it was about discount allowed, discount receive, okay, would have talked about that as well. Okay, so if we have discount allowed, discount receive, and those things, we have to take into account that as well. Okay, clear on that? Understood?
Yeah.
Let's move forward. Now we have to prepare the income statement for the year ended 30th March. Again, for 12 marks in this question, we have to make sure the income statement for the year ended 30th September 2022. Okay, so we have Yamini income statement for the year ended 30th September. For Yamini, we have to make. Okay, with me following, understood, getting it clear?
Yeah.
So here we go. Let's start off. We'll have to make two accounts, two columns, sorry. So here we go. Two columns are there. And let's start working with it. Okay.
Okay.
Income statement basically starts off with the revenue. So where do we have revenue? Yes, we have inventory, other receivables, other payables, direct wages. So we have the first thing up is the revenue. So how much revenue is we have, students? We have the credit sales, the revenue. So we will see that revenue is basically 78,750, right? Getting it clear?
Yeah.
So revenue is 178,750 less cost of sales. We'll have to start off with sir cost of sales as well. Getting it clear? So cost
Yeah.
of sales is basically opening inventory. So we'll write down the opening inventory first. Inventory at the start of there. So our year is starting at inventory at 1st October 2021, right? So inventory at 1st October 2021, what was the opening inventory, students? Here we go. Another information is occupied and done. That opening inventory is basically 25,750. 25,050 is the opening inventory. Understood? Got it?
Yeah.
So 25,750 is opening inventory. What are the purchases? So we have write down the purchases now. So our purchases are $90,000. From the previous part, we have to take purchase $90,000. And sir, the closing inventory will also be done like this. Closing inventory at 30th 30th September 2022. That is basically closing inventory 27,460. Okay, understood?
Yeah.
Clear on this? Got it? Any problem? Let me know. Clear?
No.
So it will be simple then that it will be 25,750 plus you will get the cost of sales, and therefore you will get the cost of sales. You are getting it as 88,290. So revenue minus the cost of sales, we will get, students, the gross profit. Okay. So some marks up till now here, 4 to 5 marks up till now here. That after you get this, we'll have to find out the gross profit. That is revenue minus the cost of sales. Okay. Understood? Revenue minus cost of sales. So 90,460 is the gross profit. Let me know. Got this? Clear on that? Any problems? Any issues?
No.
Clear? So we have got the
Mm.
gross profit here, 90,460. Now comes the important part, that do we have some other incomes, or do we have some other incomes like commission received, discount received, decrease in provision? So in this case, we have, sir, interest receivable. Okay, interest received. Let's again do the same thing. What information we have used and what we haven't used. So this information we have used, right? We have used this information as well, clearly. Understanding with me, following? We have
Yeah.
used these two informations, and the next thing we are using is basically interest received as well. Other incomes, that is $110. Other incomes, $110. So you can write down directly here that you have, sir, other incomes as well. That is interest received. Okay, getting it clear?
Mm.
Other
Yeah.
incomes, that is interest received. So you can show in one column as well, that is interest received, $110, which will give us a more updated version of gross profit. We'll get gross profit as higher. That is 90,460 plus 110 will give me 90,570 as the answer. Understood? Got it?
Yeah.
So I'm getting 90,570 as the gross profit, and then you will start, students, the expenses, subtracting of the expenses. Okay, less the expenses. Now it will come to the expenses section. Okay, understood? With me, got it clear on
Yeah.
that? Any problem?
No.
Sure. So when we talk about expenses, we have wages, we have office expenses. Drawings are basically not an expense. Okay, drawings are going to come in the statement of financial position, and we have depreciation as well for the non-current asset. Understood? Getting it clear? Following?
Yeah.
Getting it? No problem, right? No issues.
No.
You know. Okay, so let's talk about it. If we talk about office expenses and wages, so let's start off, sir. So let's first write down office expenses. So we need to do some working for it. We have to make an account of accrued or prepaid for the office expenses. Okay, do we have working for here? So office expenses, we can say, let's do the working down below, working number one for office expenses. Getting it with me, following?
Yeah.
So office expenses, you need to understand, if you are making a T account for office expenses, we can clearly say that office expenses are being other receivables. So at the start of the, you don't have to receive. So you don't have to make the payment for the office expense, but at the end of their office expenses were other receivables. They were at the other receivables. Okay, getting it? So an expense at the receivable end is means that we have to make the payment. So you will have to add them. Okay, getting it? So it will be office expenses 26,750 and subtract 400 from there. Okay, because these are other receivables. It's a prepaid amount. Okay, getting it? It's a prepaid. You have paid an extra. Let's do it directly because this is easy. This means prepaid. You have paid in advance, and this means accrued. You haven't paid in for what service you are due. Okay, getting it?
Mm.
So it will be wage office expenses 26,070. We don't need this at the moment. Okay, are you there with me? Following? It will be, sir,
Yeah.
26,750. This is the office expenses amount for the year, 26,750. and 400 will be subtracted from that. Why? Because you have paid in advance 400. We only record the current year expense and income in this, okay?
Okay.
It will come 26,350. See if you got this clear on that. Any problem?
No.
Sure about it, clear? Then next we have
Yeah.
is the wages, sir. So wages, same thing. Wages you haven't paid in what you are owing, so wages will be added up, okay? So wages is basically accrued. Getting with me, following?
Yeah.
So wages will be, if we talk about wages 33,000 and you haven't made the payment for the wages of 500, at the end of there they are owing. So it will be added on. So 33,000 plus 500 will be added on for the wages because you have to, 500 is still owing and you haven't made the payment for that wages as it is other payables accrued. So 33,500 we got it for the wages as well. Understood? Got it? And the last
Yeah.
but not the least, that is depreciation. We have to get the depreciation. They are telling us the method and the policy for it, students. Basically, sir, depreciation is charged at 20% using the reducing balance method, which means at the net book value. So we have to do cost minus depreciation and the net book value method. So it will be 50,000 minus the depreciation 10,000 into 20% the rate. Understood? Getting it
Yeah.
clear? So make sure show the whole working for this. Dep will be 50,000 minus. Okay, there with me, following, getting it.
Yes, sir.
So we can clearly see that how we got the depreciation, that is cost of 50,000, sir. Depreciation cost of 50,000 minus the net book value of 10,000. We got 40 for 10,000 depreciation value. I'll repeat. Cost is 50,000, depreciation 10,000. We got net book value as 40,000. 40,000 into 20% is 8,000. So we got the depreciation like that. And here we go. This will be our profit for the year as well. That is 22,720. Okay, I got it clear on that.
Yeah.
After subtracting all the expenses, please have a look at it. Do take a screenshot of understanding of about all the expenses. We have three expenses here: office expenses. Office expenses were receivables, which means they were prepaid. Yamini had paid in advance, so that's why we can't put more expense than it is due. We only record for the 12 months. So Yamini have paid $400 extra. That is why we have to remove it. Similarly, the wages she have paid less. She had to pay 500 of the previous year as well. So that is why we have added that you have to pay for the previous year as well. So 500 will be added in this. Got it now, clear?
Yeah.
With this, we come to the last section of the part for 2 marks to get the full 50 marks. Okay. So here we go, sir. You have to mention two accounting concepts. Come on, can you give any? State two accounting concepts, any that apply when preparation of financial statements. So a lot of concepts are being applied when we talk about the preparing the financial statement. When you talk about preparation of financial statement, a lot of concepts come into concept. So you can write down any of them like money measurement concept. Okay. So we can write down any of them. Okay. Do you know about money measurement concept?
Yeah.
Any other you want to sell? Money measurement concept. You can talk about historical cost concept, or we can also talk about business entity concept, that the owner and the business is to be treated separately. So you can write down business entity, money measurement. You can write these two. You can write the third one or the fourth one. Like if you don't remember these two, you can write down we can say that there is the materiality concept as well, right? With me following?
Yeah.
And make sure only give two. These are just if you don't remember the first two, you can write down from this as well. Okay, understood? You can write down
Oh,
about
yeah.
accruals, matching concept. Okay, so accruals and matching concept. You can write any two concepts, all of them will work. Okay, prudence concept, materiality concept, consistency concept as well. Okay, getting it,
Oh,
falling clear on that? Any
yeah.
problem?
No.
The fifth one can be consistency concept used for depreciation method. Okay. So here we go. Okay. Consistency concept. Okay. Come next part. That is the last part for the question. Evaluate the change in liquidity from 2021 to 2022. Again, it's a ratios part as well that Yamani provided the following information at 30th September. So at the end of the year, she is providing us with the information, sir, and we have to evaluate the change in liquidity from 2021 to 2022. We have the current ratio and the liquidity ratio. The first thing is you should better know about these ratios, the definition of current ratio and the liquidity ratio, and then we'll see whether it's good or bad. Okay.
Hmm.
Understanding, getting it clear? Okay.
Yeah.
So what will be again the same perspective? 4 marks are for writing for whatever reasons you think it has improved or worsened, and 1 mark is for decision. So let's write it down again that it's from 2.1 to 2.3 ratio 1. So current ratio is happening what? From 2.1 to 2.3. That current ratio is improving. Okay, getting it clear? The current ratio is
Yeah.
increasing. Okay, so if we talk about first the current ratio, sir, the current ratio has increased. The current ratio has increased. The current ratio has increased from year 2020. The current ratio has increased in 2022. Getting it? The current ratio has increased in 2022. It means that now to pay one liability, you have more assets. Okay, getting it? Which indicates, which indicates are you getting it? For one liability, you had 2.1 current assets to pay. Now you have more assets to pay because current ratio formula is, sir, current assets divided by current liabilities. Okay, understanding? Current ratio formula is what? All the current assets divided by the current liabilities. Are you getting it clear? So the
Yeah.
current ratio has increased in 2020, which indicates that more resources are that current more current assets are available to pay for liability. More current assets are available to pay for the liability. More current assets are available to pay for the debts or liabilities. Getting it clear? More
Yeah.
current assets are available to pay for the current liabilities. Okay, getting it clear? More
Yeah.
current assets to pay for the current liabilities. More assets are available to pay for current liabilities. Or you can say that whenever they are due, the funds are available for the shared resources. However, however the ideal ratio is 2:1. Getting it? However, the ideal ratio is 2:1. So you can still write down the business is not making efficient use of the resources. Okay, so the business is not, there are still idle, the business is not utilizing resources properly. Okay, the business is not utilizing resources properly because you need to understand that the best ratio is what? 1:1, right? The business is not utilizing resources effectively. Understood? Getting it? So you can write
Yeah.
down for this one. Okay, and you can write down more points as well, whatever comes to your mind. The next is liquidity ratio, 1.2:1 to 0.8:1. So you can say the liquidity ratio has worsened. The liquidity ratio has worsened, right? The liquidity ratio has fallen down. So again, the liquidity ratio, that is the liquidity asset plus ratio, the liquidity ratio has worsened in 2022, fall in worsened in 2022, it have fall worsened in 2022, which means that what happened, you must know what is the formula for this. It is current assets minus the inventory. So in liquidity ratio, you have to subtract inventory divided by current liabilities. Getting it clear?
Yeah.
So it's just the same thing. It's just that to get an idea of the more liquidity, quick liquidity, where you stand in the cash management thing or the liquidity thing, your bank, either you're
Oh,
going to go become bankrupt or not. What's your status of paying the money, working capital cycle resources? What's your status of working capital cycle? That's what we talk about in this, okay? So we need to understand that the liquidity ratio has worsened in 2022, as we can see, students, as we can see, sir. The ideal ratio for this is 1:1. Getting it? The ideal ratio for
Yeah.
this is, you can write down this point as well. The liquidity
Okay.
ratio has worsened. The ideal ratio is 1:1. The ideal ratio for each current asset, there should be one, for each current liability, there should be one current asset available, which we are not at the expected. Okay. So, and what will be the reason? Uh, this meant, this means that what's the problem here? Why it has reduced? What's the reason here? From 1.2, previously you have 1.2 asset to pay for liability. Now you have less than one asset to pay for a liability. It means that the business will have, it means that the money is being tied up in the inventory. Okay, getting it? This means that money is too, this means that money is being tied up, extra money. This means, or you can write down extra, apart from the word of money, you can write down funds. This means that funds are tied up in the business. Getting it? This means that funds are tied up. Getting it? This means that the
Yeah.
funds are tied up in the funds are tied up in the inventory. In the inventory might be leading to cash management problems. Might be leading to cash management problems. Might be leading to cash management problems or liquidity, cash management problems or liquidity might leading to cash management problems. Getting it, careful? And then
Yeah.
what you will write, we can clearly see here, okay, this is increased by only 0.2%. This is gone by down by 0.4. So we can clearly say, hence the liquidity has worsened. Okay, getting it? That will be the decision.
Okay.
Hence the liquidity has worsened. Okay, hence the liquidity position has worsened. Okay, getting it? Hence the liquidity
Yeah.
has worsened. Or you can write down, the business short-term liquidity has worsened. So make sure take a screenshot of this. I'll send the paper as well. For today we are
Okay.
done. Hope you got the complete paper, and we'll
Yeah.
continue in the next class with another paper. Okay, students, thank you. Take care. Bye.
Okay. Thank you, sir. Bye.
Any questions you have to ask? Any
Oh no.
questions, queries? Okay, that's
Oh
good.
no.
Make sure revise the paper, and we'll continue from here.